Hey, can you guys see the stream?
Yes, yes, yes.
Yeah, can you guys see?
Yes, we can see.
Okay, great. So today we'll discuss option strats. We'll basically just start off with the tweaks, right? We'll just brush up on them again. We'll just look at different strikes and see how they behave. After that, we'll move on to credit spreads. I'll explain what a bear call spread is. I'll then explain my current position, the screenshot I sent on the mentorship group. Then we'll have bull put spreads. Then we'll move on to debit spreads, which consists of bull calls and call puts.
Energizer,
Yeah.
your voice is not clear.
Okay. I mean, there's not much I can do, I think. One second. Whose wire? I'm on earphones. I mean, I have the wireless one. Let me just check.
There's a static coming in.
Should
Can
I?
you try reconnecting your earphones?
Okay, I'll do that. One second. Okay. Is it fine completely?
Yeah, it seems better now.
All good.
Yeah, we can hear you clearly.
Right. Okay. Chalo. Uh, so let's just start all over again. And basically, what we'll go through today is we'll just look at the Greeks again, simple calls, and then we'll discuss credit spreads. We'll discuss bear call spreads. I'll then talk about the current position that I have. I send the message on the mentorship group, right? After that, we'll go on to bull puts, debit spreads. We'll also discuss back spreads, which are two types. You have ratio spreads and you have ladders. And then we can go on to covered calls and wheels. And we can end with like a small session on passive trading and stuff.
Something.
Fine, but then how do I stream my screen? Can I join? Can I stream differently? Can I join the mentorship channel through my phone? I'll speak through my phone if that's better. But then I want to share my screen, right? It doesn't make sense without it.
Do you have any other alt account?
No, I don't have an alt.
I think you can do like that. Stream on one platform and
Yeah, Energizer just send one of the
Ye-
documents or the links to any of the guys streaming. They'll and then you can talk on behalf of it.
nahi, chalo. How long will it take to make an alt? 10 minutes?
Yeah.
बना ही लेते हैं. Okay.
Yes.
We can hear you clearly now.
Yeah, voice is very good.
Sure. Fuck, finally. Okay, can you view the screen now?
Yeah.
Yes.
Okay, chalo.
And we
You
can hear
guys
you
couldn't
clearly.
anything.
Yeah, everything
You
is
guys,
good.
you guys couldn't hear anything I spoke earlier.
No.
It was like
No.
feedback. It was warbling.
अच्छा पता नहीं क्या चल रहा है. ठीक है. So
Sorted
for the
out.
third time, the contents of today's lesson. We'll initially just look at the Greeks. We'll initially just look at what a call is, what a put is. We'll just refresh that quickly. So credit spreads, we'll explain all of that. We'll explain bear call spreads, and then I'll talk about my current position. So the screenshot I sent on mentorship, that was a bear call spread. We'll look at bull puts, we'll look at debit spreads, bull calls, bear puts, bear spreads, covered calls, wheels, and then we'll end with some passive trading techniques, or however you want to name it, some trading tips for beginners, how you can take like a first options trade and stuff. Chalo, theek hai. So this I'm currently using Sensible. You guys can use Opstra if you want. It's all the same thing. And just checking one more time if my stream is okay.
Yes.
Okay, so currently, as you can see, Nifty is currently at 17,000, right? So if you want to buy a call, let's just look at what happens. We've spoken about 3 strikes already: OTMs, ATMs, and ITMs. So when you build a strategy, this is the option chain which comes up. Nothing is important here. You'll learn what the put OI is, what the open interest is, and everything later on. On a very general level, all you currently need to know is where the in the money options are, where the out the money options are. For a call, we're calling the markets up, as we've discussed earlier. When you're calling the markets up, everything which is above this line, right? So everything above 17,100, we are calling the markets up above 17,000, which is the current strike. So that is OTM, right? And in the ITMs become all of these beforehand. And what's the ATM strike? The strike which is closest to where we currently are at. So 17,000. Let's just see what happens when we buy like a 17,000 call. Now, as I think we've discussed, so this is the basics of what a call is. Your max profit is unlimited, and your max loss is limited to the amount of money you've paid. Now, how do you arrive at this number? This 6,000 something number can be looked at by what's the max loss that you can have. Your option can go all the way to 0. So it's got a value of 133, and it can go all the way down to 0. So that's the maximum amount of money you can lose, which is 133 multiplied by whatever lot size this is. So we're currently looking at Nifty. So Nifty's lot size is 50. So that's the maximum amount of money I can lose. 50 into 133, which should be 6650. Right? Now, what is my break even? Here, break even is 17133. Now, how do you arrive at that number? Again, you look at the strike, you look at your 17,000 strike, and you're currently paying 1,333 bucks. So you have to recover all of this premium. So when you buy options, right, you are paying money. You are giving them money. So to break even, you basically need 17,000 plus 133, which is 17133. Then you have something called the probability of profit. As you can see, the probability of profit here is extremely low, it is just 35%. On the other hand, the funds needed extremely low. Margin requirement is basically nothing. It is just 6,000 bucks, and your returns are roughly 30%. So if this works out in your favor, then you will make a lot of money. So this here you can see the chart. So in Opstra and everything, it's all the same. It doesn't really matter. So as you can see from here, your break-even price is at 17133, and at 17133, your expected P&L on target date, these are all the numbers and stuff that you can see. So you keep making money as the market goes up. So this is fairly obvious. Now, the Greeks. Here, you can basically see that your delta is positive, as it should be, right? Because what is delta? Delta is basically the rate of change of the underlying. So yeah, okay, so change in your PNL with 1 rupee change if nothing else changes. So delta of 25 means you will basically make 25 bucks each time the stock goes up by 1 rupee, right? Which makes sense because what's the lot size here? The lot size is 50 and 25 is the amount of money. So again, your delta, the number, I don't know where I can see that, but it should be 0.5. I'm not used to any of these strategy builders, so I can't really explain, but the delta of this thing, this is in rupee values, right? This is how much money you will make or lose. But the delta of this strike should be at 0.5. And that makes sense. So 0.5 into 50, which is the lot size, is giving you this number, which is 25. So does that make sense? So we've discussed ATM's car, the delta will be 0.5. So 0.5 into 50, that gives you 25. Your theta here is negative. Why is the theta negative? Again, you're buying an option, so your theta has to be negative. You will lose money on each day that passes. Gamma, we've discussed what gamma is. Gamma is basically the rate of change of acceleration, how fast your delta moves. So how fast your delta moves, how fast this number moves depends on your gamma, right? So you will hear terms like gamma contraction, gamma expansion, and that is basically something that you use in expiries when in the last hour of expiries. We'll discuss all of that later. And vega is volatility. Why is volatility positive? Because when the IV goes up, if you've bought an option, you make money, so it goes up as well correspondingly. So you are long vega. One second. Let me just choose this. Achha, theek hai. So I hope this much is clear. This is just what we discussed earlier. Nothing new here. So let's start off with the first thing, which is a hedge. Now, why should you hedge? The reason behind hedging is at least you aren't faced with the fact that you can lose a lot of money. So instead of losing 6,600 bucks, it might be too much for an account to handle, especially for people with smaller accounts or for people who just don't want to lose money. Buying calls doesn't make sense. So you probably want to have a fixed max loss, even if it comes at the cost of a fixed max profit. The other advantage is it usually makes it cheaper to execute trades as well. Okay, first things first, what's a credit spread? A credit spread is any strategy in which you are net negative, in which you have sold an option and that has more value, right? So any strategy, it doesn't matter how many legs you have. If you have sold, for example, it could be a 10-leg strategy in which you sold 10 different strikes. If you have sold like 6 more valuable strikes and you've bought 4 less valuable strikes, it is still a credit spread because you will be making money in this particular scenario. Okay, so let's just look at a bear call spread first. Bear call spreads and bull put spreads are what I highly recommend to beginners. These are the two main strategies that you should be playing around with. And the entire goal is to just keep trading for as long as it takes for you to understand what the market does. It's not like you will understand trading within the first year or within the first day or first month or something of that sort. It can take a ton of time, but you just need to be positioned where you have a fixed max loss. You aren't losing a lot of money, and you're still getting something. Okay, so a bear call spread. So we want to be bearish, as the name suggests. So bear, we want the markets to fall, and at the same time, it's constructed using calls, right? So a bear call spread. Now, a bear call spread is basically used in the current scenario. So as I'm sure you guys know, Nifty, it fell quite a bit, right? Let me just pull up Nifty's chart and I'll explain it then. So yeah, moving to the 1-day chart. And on the 1-day chart here, you can clearly see that Nifty had fallen. It had reached its high
Bro, we
of
cannot
around.
we cannot see your chart.
You can't see my chart. You can't see my trading view tab.
Yes, sir.
Hey, fuck. Okay, doesn't matter. Anyway, you guys probably know Nifty made its high of 18,600. Right, I'm looking at the Nifty 50 index chart. And then it fell all the way down to 16,443. So it fell down to 16,443, and then over the past 3 days, it went up and it made a high today of 1715 something, 17,150. Okay, so in this particular scenario, what has basically happened is the markets have rallied considerably. So from 164 something, 16400, it has gone up by quite a bit. Now what happens is in this scenario, the value of your calls, they really swell up in value. So the value is slightly skewed if you compare the value of puts and calls. This is something which you will have to learn through practice. So this is something I would highly recommend you guys start doing right away. Take your phone, go to Zerodha right now, and then just look at the different strikes. Look at say 17,500 strike. Okay, I think I can just show that to you, right? So if we look at 17,500, you can see like a significant difference between the values, even if you go 500 bucks up. So the value of a put is 7.6 here. If we go 500 bucks back, the value of a put is 24. So there's a difference that you see. So a bear call spread is implemented when the markets have rallied and the call premiums have swelled up. So how you construct the strategy is you basically buy something which is out of the money. So an out of the money call could be something like, let's just say 17150. This is out of the money, correct? Or 17200, whatever. It depends. We'll look at the different places that you can go, and you can buy one of those. So you buy one out of the money call, and since the bear call spread, so the difference of the strikes is between the call itself. So you will sell something which is below here. So you can sell what is an in the money call, and in the money call is anything which is below here. Okay, so 17200, and let's just take a random example, 16900. Okay, so now this is what a bear call spread looks like. As you guys can clearly see, when the markets fall down, you will make money, and your profit in this case is capped. There's only a certain amount of money that you can make, but on the upside, there's only a certain amount of money that you can lose. Okay, so let's look at the max reward. The max profit here is 7,000 bucks. The max loss is something similar at 7,000 bucks, but your probability of profit is now much higher. Your probability of profit is now 54%. So anything over 50% is at least you aren't completely gambling. You have something in your favor. And your break even is at 17045. And currently Nifty is at 17003. So you basically have a little bit of a cushion. Even if the market moves up by 50 points or 40 points, you still don't stand to lose money, right? You will still be profitable somewhat. The total margin needed again is just 26K. So this is one of the basic strategies that I suggest that you guys start implementing, because your max profit is fixed, your max loss is fixed. You can't lose more than a certain amount of money, and probability is slightly in your favor. So let's look at the Greeks very quickly. So your delta is negative again. We've just got a bear call spread. Why is my delta negative? Because I've sold a call which has higher value. So I have one leg sold, I have bought one leg. However, the value of 16,900, which is in the money, is much higher than 17,200. You can clearly see this is worth 194 bucks. This is worth 48 bucks. Okay. So this is why it's a net negative strategy, and my delta will obviously be negative. My theta is positive because again, I am more on the sell side. So since my sell strike is greater, my theta will be positive. So each and every day that passes in the market does nothing, I will make 240 bucks. Okay. Then you have your gamma, which is again negative because gamma and delta will just move together. And then you have your vega. So volatility is negative here as compared to your long call. Why is there a difference? Because again, you are selling. So if IV goes up, that will be against you, since the value of the calls will go up. And in this case, how will you actually make money? So you want to get to a certain point where this value and this value goes to zero. Okay. So when does that happen? So if the market 16900, I have sold this. And if, okay, before we even get there, let's just look at what the max profit is. How do you calculate your max profit? Your max profit is basically your net credit. This is a credit strategy where you will make some money, right? Where you get some money. So your max profit is the net credit, which is nothing but the difference between your strikes. So 194 minus 48. So 200 minus 50 is 150. 150 into 50 should give you this exact number. Okay. And what's your max loss? Your max loss is your spread minus the net credit. So what is our net credit? The net credit here was 150. Now, what's the difference between the strikes? 300 bucks, right? I mean, 300 points or whatever you want to call it. So 300 points minus this spread, which is 150, is again equal to 150, which is why the returns that you get here are fairly straightforward. Okay? Just going to look at the chat now. If there is any doubt so far, what your break even is it clear what a bear call spread is? We'll discuss the different legs that you can take and everything.
Energizer, when do we go for bear call spread?
Go
I
for
mean,
a
why
bear.
not just
Hmm.
yeah,
You
why
go
not
for
just
a.
sell?
Why not just sell an option?
Yeah, I mean, why are we going for call spread? Is there a logic behind this?
Uh, okay, why am I going for a bear call spread as compared to a naked call sell? Is that the question that you're asking?
Yeah, let's just say that way.
Okay, so if I sell like a naked call on Nifty, the margin required, I'll go back to the table here. The margin required, I think, is around 1.4 lakhs. Okay, and over here, it's just taking 25,000 bucks or 26,000 bucks. That's a big difference. In the same amount of money, it'll take me to like short one call. I can sell probably like 5 lots in the same amount. Okay, so that's one difference. The other difference is, at least in this case, my losses are capped, which is the most important thing for beginners. Or, I mean, risk management is the most important thing for any trader, even for prop fund guys and everything. All they really care about is how much risk you're taking. So this is the main reason behind taking like a bear call spread. And why are you using calls? Why are you selling a call and not just buying a put instead? Because again, the calls, since the market has rallied all this while, you're basically going for a reversal type of trade. So in this reversal type of trade, you will have a better advantage. Okay, since the calls have really how to execute it? Yes, Apan, exactly. You first buy the call first, buy the out the money call first, and then you can sell in the money. And then even if you have like a 50K account or a 1 lakh account, you will still be able to execute the spread. Now
Got it.
this chart again is pretty self-explanatory. If you are confused about what this blue line is and what the green line is, how do I get rid of this cursor, man? I don't know. So the blue line that you're seeing is what will happen, what your profit will be before it expires. Green line will be what will be at the time of expiry. So blue line is, suppose the market falls, market's currently at 17,000, and the market now falls all the way to say 16,850. On target date, if it falls on tomorrow or something, my max profit will just be 4,000 bucks. It won't be 7K. But if this happens, if this is where the markets end on Thursday, 30th December, which is the expiry, excuse me, I will make 7K. Why is this difference? Again, you have sold calls, you have sold options, so the premiums won't go to zero until expiry date. Okay? I hope it's all good so far.
Yeah, all good. All good.
Okay, now let's just get to the trade that I had taken. Okay, so what I basically had, I had sold 17150. And bought 300. Yeah, so this is the trade that I had taken. I had taken this trade the day before. No, I had taken the trade yesterday. And this is what happens when you play around with the strikes. Now, Nifty is currently at 17,000. And if you sell this strike now, yesterday I'd sold this when the markets were around 17100. Okay. So when the market closed at 17100, I just took the 150 call, which is, if I look at the option chain, I hope you can understand that this is now above the strike. So this is an out the money call now. So I sold an out the money call, and then I bought an even further out the money call. So these are the kinds of trades I prefer to take.
Can I change my price? 1 second, let me just check my position and then I can input the actual prices. Probably go look at the chart and see, at what time exactly these prices were found the day before. So 111.85 and 54.7. So this is the trade that I took. The probability of profit was 73%, which is pretty nice. My break even here is 17,200. And this is when the markets were at 17,100. So I had a 100-point cushion, right? And my the only problem here is even the margins require a fairly low 25,000, which is the same as earlier. But the returns are now pretty low, right? It's just 6% now, and my max profit is just 2.8K per lot. And my max loss, however, is a lot, like it's minus 5K. However, the probability of profit, this number is what I think beginners should focus on, unless you truly understand the markets. Just keep probability in your favor, and over time, you should be able to make money. Again, there are various things here. For example, you should really know how to exit this position, because if the market keeps rallying, for example, let's just say on Monday there's a huge gap up, and the market goes up by like 200 points, which could happen. When am I supposed to exit? That is an extremely important factor, because if my current call, the 150 call, I'm sure you guys remember the option chart. So an out the money call will not have much delta, right? Let's just assume my delta was around 0.2, 0.3 or something. And my Vega will also be pretty low, and my Gamma, sorry, will also be pretty low. But if the market moves upwards to 150, if the market moves upwards, my out the money call now becomes at the money, right? And because of that, the delta will go up from 0.2 to 0.5, and the gamma will also go up. So it will be extremely difficult. So basically, I will start losing a lot of money extremely quickly. Okay, so I hope this makes sense. You have to be very careful in the sense that these are the kind of trades you want to take. Make sure you have a good probability of profit, but at the same time, make sure you have an exit plan. Make sure you have like a proper stop loss set into place, so you can figure out that if the worst does come, when exactly will I exit? How much money am I willing to lose? And you can even construct trades like, for example, if the market goes all the way up to 17300, 17300 over the next couple of days, okay, my max loss on target date before it reaches Thursday, I'm talking about Monday, will be around 2K. So I can close my position right off there. So technically, my max profit is 2.8, and my max loss can be somewhat limited due to a stop loss. So I don't have to take the entire max loss. Okay, so I hope this makes sense. Even though technically, if you read any book on options, you will always have the same thing: buy something out the money and sell in the money calls. However, to increase the probability of profit, and I just think in real life, this just makes more sense. However, it depends on you how aggressive you are as a trader. If you're extremely aggressive, then yeah, by all means, follow what the books say and see how it works out for you. Maybe you're much better at predicting directions and stuff than I am. I just prefer having a bit of a cushion, and this is the position that I took. The other thing was, as I shared the screenshot, uh, based on price action, which Lumiaman explained, right? It's just looking at the chart and the price and the volume only. I had this assumption in my mind that the market should at least start retracing from here because we've had such a big up move, and it's just been going up. So I have a few strats in place where I know the probability of the markets falling or dumping properly are much higher after gap up. After a gap up opening, the probability of the markets falling and having like a proper falling day are much higher. How do I know this? I've made my own DDs. So I've gone back in time, I've looked at charts, I've written all of this stuff down and arrived at a probability. So which is why I told my friend that, you know what, the problem here is based on my DDs. I don't want to, but if the market opens the gap up, I will have to short more because the probability of my trades working out will become extremely high. The probability of a trending day usually occurs when the markets open even or with a small gap down. That's when you have this trending day that the markets just keeps going upwards. Okay, so these are all DDs, and you can construct all these charts for yourself, and then you have a better idea of how the market works and functions. Okay, so I think bear call spreads and this position, I hope it's clear. Any doubts on my position?
You mean you simply sell and buy both OTMs? That's it?
Yeah. simply sell and buy both OTMs just because the probability of profit is much higher, right? So the max
Yeah,
is in
okay.
my favor.
Got it.
That's all it is. The probability is in my favor. That's all it is. Okay. Now again, you can mess around with all of these screeners. I'm currently using Sensible, but you can also view Opstra. Opstra is again free. And just for fun, let's just, since this is our first strat, let's just look at completely in the money. So let's just buy 16900, which is in the money, and let's sell whatever something. Now you have the same thing. This is still a bear call spread. You are bearish in the markets and you've constructed using calls. But now look at what the chart shows. When both of my options are in the money, my max profit is extremely high. My returns are insane, but my max loss is very low. Right? But however, the only problem here is the probability of this happening is extremely low as well. In the previous example, when I had sold both OTMs, my probability was 74%. That's the trade I took. And I had a cushion, even if the market moves up by 100 points against me. So I am completely wrong. I will still have time to exit my position and not lose much money. However, in this scenario, you can see my break even, the point the markets have to make before I start making any money is 16861, which is extremely far away. So currently the markets are at 17,000. And for you to start making money on this call, it will only happen once the markets fall down by nearly 1%. Okay? And even then, you will have to hold it for a longer period of time, because even if this happens tomorrow, let's just say there's a gap down on Monday, and you're extremely happy, okay, markets fell by 200 points, I'm going to make so much money, I'm going to make 5K. Your profit will still be extremely low, because you will have to wait for the entire value to decay. And what happens is after the markets fall, they pump up again. So it gets very confusing and very conflicting. So I highly recommend people to stay away from most of these strats unless you know something that the rest of us don't, or you have some extremely solid view in place. Or the other scenario in which you would implement such strategies would be when you have you've backtested all this properly and you realize that, what, I just need to win once, and even if two times I'm wrong, overall my strategy is still profitable. So I will practice the strategy 100 times, I'm wrong 70 times, I win 30 times, but overall it is still net profitable. Once you calculate all of that, then you can still continue. I think that's all there is to bear call spreads. We've covered all three. What the conventional version is, would be buying one out of the money call, selling something in the money, and just waiting, where you will basically get like a proper break even, right? It depends on your spreads as well. And I hope what your max profit is here is extremely clear. So your max profit, I mean, this should go without saying now. So it's 300 minus 194. So this is about $100. So 100 into the lot size. One lot is 50. So 155,000. Max profit is 55. Okay, whatever. That's $4 and $5, right? That's 995 something. Your max profit is around 5.5K. Again, the difference between these strikes, because once the market goes all the way back, you want this to go to zero and this to go to zero. You've paid money for this, you will lose money here, but you will make all of this money. So you want to lose 194 points, but you will make 300 points. Your net will be this much. Okay? So let's just move on to strategy number two, which is a bull put spread. So bull put spread, it's the exact same spread, it's the exact same, just in the other direction. So in this case, you want to buy this, it's the exact opposite, right? So when the markets have fallen a lot and the put values have really gone up in value, and also there's high IV, because as we know, when the market falls, there's more IV, right? Because there's more panic in the market, anything can happen. And because of IV, you expect the put values to go up by a lot because of two reasons. One, the IV, and secondly, because the markets have been falling. So you can take advantage of both of these factors by using a bull put spread. Because in a bull put spread, again, you are selling options. It's a credit strategy. This comes under credit strategy. So you are selling an option. And what happens is, since the IV is extremely high, once you've sold, if the IV falls, regardless of where the market moves, you will make some money, right? So, okay, let's just explain with the help of a diagram. So here what you have to do is buy something out of the money, buy one out of the money put. So Nifty is currently at 17,000. Now what is out the money? out the money is something below it, right? So something around here. So you can buy a one out the money put, 16,900, and you can sell something which is in the money. So what's an in the money put? Something which is already making money right now. So let's just say 17100. Okay, so this is a bull put spread. Again, you're bullish on the markets. Okay, so you will make money here, and let's just look at the different strikes now. I'm purposely selecting different strikes to understand the various points, right? So over here, I selected 100 points up and down. Here, again, it's giving me 50% probability of profit. My break even is more or less the same. I am getting a cushion of around 10 points, 15 points, but in real life terms, it doesn't really matter that much. And so yeah, so in this case, you can do all of the same thing that you had initially expected. Whatever we learned the previous one, what is my max profit? My max profit in this scenario is, okay, it says 4,000 bucks. Why? 178 minus 90. So 180 minus 90 multiplied by 50, which is the lot size. If you're trading on Reliance, it's the exact same thing. Just look at the difference between them, multiplied by the lot size. Some will have 500 as lot size, some 3,000 bucks. It depends. And when you multiply all of that, you will get your max profit. Now, what's your max loss? The max loss, as we've explained previously, is the difference between the spread and the net credit. Now, what's your spread? Your spread is the difference between the strikes. So here, the difference between the strikes is 200 bucks, correct? So 200 minus whatever the amount here was, 90, right? 90 to 180. So 200 minus 90, which over here is 110, which is greater. So 110 into 50, which is 5550. Okay. I hope this makes sense as well. It works the exact same way. You can look at the Greeks again. Your delta is positive. Yes, of course, you are bullish. Theta is right here. Decay, gamma, vega, all these strikes are here. Now let's just see how I would take up this trade. Now, as I've mentioned, I don't really like 50% trades. So let's clear this. Again, I'm mainly focused on the probability. So I want to sell. So sell this by this. Okay, yeah. Now, I sold and bought. And the first question which probably strikes your mind is, why is this so different? In my strat, I had like a 73% or 75% probability of profit. And even the odds were slightly more normal. Here, the risk to reward ratio is 0.3. In my case, it was slightly better, 3,000 to 4,000, something of that sort. This is why I'd implemented a bear call spread, right? Because puts don't really have much value right now. Calls have more value, which is why I implemented a bear call spread. So I hope this completely answers the first guy's doubt on why did I even choose a bear call spread. Okay, so this is the type of trade I would have taken. Again, let me repeat, when you take this on a decline, so puts have more value. This is obviously not the case. I'm doing this live in front of you. So it doesn't really make sense now. And your max profit, again, in this case, is the difference between these two strikes, 90 minus 64, comes up to 1,000 bucks. Your max loss, again, the difference here is 100. 100 minus the difference between this, multiplied by 50. Okay, so this is what a bull put spread is. So if the markets have significantly fallen, so let's just look, if you were to take this trade 4 days ago when the markets were at 16440, you would have made a lot of money because the puts would have a lot of value. And I really like taking all of these bets, like bull puts, bear calls. These should be a trader's bread and butter, more or less. Okay. Everything clear so far? These two, as I've mentioned, the most important. Far.
So I did have a question there. So both of these are like bearish strategies, right? Or
No,
like
no.
when you're expecting it to go down.
I'm doing the ulta thing. Basically, with puts, what I'm doing is I'm building a bull call. I'm building a
Okay.
bullish
So
strategy.
on
And
puts
with calls,
you're
I'm
expecting.
pulling. Bear. Again, I'm selling,
Okay.
right?
Mhm.
So why do I have an advantage in this place? At least I have theta with me. If suppose I'm bullish and I buy a call, theta is against me, right? Basically want theta to be with me so I have some probability of making money. Irrespective of how good my price action is, give me some buffer, give me some probability. And again, I deviate from the basic books. The basic book say for a bull put spread is buy something out the money and sell something in the money. I'm not bothering with that and I'm just selling out the money just because I have a better probability of profit. So that's all it is. This is the way I trade. I mean, everybody else will have a different way of trading. But for me, the math is extremely important. Okay. So regardless of how good my chart reading skills are, I just want to be in a position where I can still make some money. And it's not like you don't make enough money. We'll get to that at the end. You know, you can even YOLO with all of these strategies on expiry day and stuff, but maybe I shouldn't tell beginners all that. Okay, so I think we've covered a couple of these credit spreads. Then you have debit spreads. Debit spreads, 1 second, please. Guys, give me 2 minutes. I'll just go drink some water. Yeah, okay, so let's continue. First, let's just look at a bull call spread. Let's clear all of this. Again, in a bull call spread, you're basically buying an option, right? A call. With a call, you expect the markets to go up anyway. But now you'll be hedging that call. So in this case, what you traditionally do is buy something at the money and sell something out the money. And since you are net long, again, the previous example, it doesn't matter how many legs you have, even if you have 10 legs. If the majority of them are long, you want the IV to be low because when the IV goes up, you will make money, right? And theta will obviously be negative. So each passing day that the move doesn't come in, you will keep losing money. Now, how do you construct this? Again, buy something at the money. So you're buying this at the money call, and we'll sell one at the money call. So something, say, 100 points away or something, you can just sell this. Now, we've again used calls, but this time by buying the more valuable strike. So we are buying 133, we are selling 82. So in the other cases, what we had done is, what the options we had sold had more value. So in this case, it's the opposite, right? And your probability of profit in this case is 45%. What's your max profit? Your max profit this time is ulta. So your max profit is, what's the difference between a spread? It's the spread minus the difference between this. So it's 100 here, 100 minus 50, so which is 50 bucks. So this is your max loss. And what's your max profit? Your max profit, yeah, your max profit is this minus this. And what's your max loss? Your max loss is just the difference here. So in most of these cases, this can be slightly skewed in the sense that you can make more money and your max loss is slightly more capped. But again, you will have a slightly worse break-even position. And the margin needed here is even lower. Why is the margin needed for debit spreads low? Because again, your buying is much cheaper. You're buying something more expensive, you're selling something which doesn't really matter as much. So this is how it works. Let's look at the Greeks. Delta, again, positive, bullish strategy. Theta, negative, because you're losing money on every single day. and then gamma positive, again you're bullish, and vega positive, because if volatility goes up, vega goes up, you will make money. Okay, so that's fairly simple. Now now let's just construct like a different, let's just construct a different bull call. So if I was extremely bullish, probably buy something in the money, and maybe something here. So yeah, in this case, what we've basically done is we're buying something which is in the money and selling something which is at the money. Either at the money, or I would still stick to like selling out the money. Again, the only difference is my probability of profit changes the more out of this I am. Okay. So this would probably be something similar. I have a 55% chance. And the difference here is my risk to reward is pretty messed up, because I will just be making, what's my max loss? My max loss is the difference here, 135 minus 195, okay, multiplied by 50, and my max profit is 100 minus the difference here, which is roughly comes up to 2,000 bucks. So that's all this is. When do you implement a bull call strategy? When you expect like a big ass move. So a big ass move in your direction, you're moderately bullish, but not bullish enough to just buy a call. Why is this better than buying a call? Because with a call, with a simple naked call, it will lose value extremely quickly. So it doesn't make sense at all for anybody to buy naked options. Okay, so you will lose money extremely quickly because of theta. So over here, you can see that you will lose money here because of theta anyway, but it'll be much smaller because at least you have sold something. Okay, so that's the big difference here. I think everything else is fairly simple. Your net debit is basically the amount of money that you've paid here minus the premium that you've received. You will receive this premium, right, when you sell the option. Okay, and then we can move on to bear put spreads. So bear put spreads, again, when you're moderately bearish, but not so bearish that you will just randomly buy a call. You'll randomly buy a put. And again, puts are bearish instruments anyway. So you can buy something in the money and sell something out the money. So for a put here, what is in the money? Anything on this direction. So you can buy this and you can sell something out the money. So now again, constructing using puts, you are now bearish and you've hedged your position in a slightly better manner. Okay. What is the net debit? What is the amount of money that you'll need to put up with this? That is whatever money you've paid for it. You've paid for this, but you've received some money here, right? So the difference between these strikes here, which is also your max loss. Well, 178 minus 89 into 50 is your max loss. And what's your max profit? Your max profit is here. I've purposely taken these strikes because they're 200 apart. So 200 minus whatever the difference here is. Okay. Your probability of profit here is 50, but the lucky thing is risk to reward ratio is in your favor. Again, if you look at the Greeks, your delta is negative, theta, you will lose money, and everything else remains the same. Another advantage of using all these spreads is theta doesn't kill you completely, vega doesn't kill you completely, because they are pretty much, somewhat hedged at least. At least you've bought one leg. So if you've bought one leg, you are short theta. But if you sold another leg, even though the theta values would be different, it's still better than outright buying and outright selling. So vega as well as theta can be taken slightly out of the picture. You don't really have to bother about them way too much. Okay. There are also strats in place where you just play vega, you just play gamma, you just play theta, right? Those classes will be taken later on by the Y. So those are called non-directional strategies, where you don't really have a direction at all. It doesn't really matter where the market moves. You're basically just playing the Greeks and trying to make money.